Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week's topic, guys, we're going to talk about quality over quantity. A lot of you guys are just kind of throwing shit at the wall and hoping it sticks. It's not a good approach to trading. So we're going to talk about something that I like to call perfect patterns rarely fail. So we're going to take a look. It's mostly chart-based. There are a few text slides, but we're going to take a look at a lot of different charts today and kind of get your input on which ones you think are really nice that would kind of meet your criteria to trade versus what I think are perfect charts. So when you're going to see a balance there's going to be a little bit of gray area sometimes. So that's the balance. That's the challenge as a trader, right? You have a trading plan, and your trading plan should basically have perfect patterns in it. But I'm guessing at the end of the week, at the end of the month, that you're not always taking perfect patterns. So you got to ask yourself, why? Is it fear of missing out? Is it the need to be right? Is it the need to make money? Why aren't you choosing higher quality trades? So I'm here to tell you that generally speaking, increase your quality, slightly decrease your frequency, and your P&L will also be elevated, increased as well. You have to stop just going, oh, that looks good, or oh, so-and-so mentioned that, I have to take it. Stop it. Have a pre-trade checklist. Keep it simple and understand that high quality is where it's at. Again, you might slightly lower your frequency, but I'm telling you, your P&L will definitely go up for this. All right, so if you like these videos, please click the like button, hammer that subscribe button. I am Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is perfect patterns rarely fail. Why? Because perfect patterns rarely fail. All right. The title is in and of itself enough. So we're going to talk a little bit about what you guys are doing and some of the FOMO that you might be having, as well as maybe the lack of patience, which kind of relates to FOMO, discipline, not following your plan, not having a plan, not having a pre-trade checklist. It's a rhetorical question. You can raise it, in your own office space where no one is looking, so no one knows. But how many of you out there don't have a pre-trade checklist? And if you do have one, how many of you don't use it on every trade? You kind of just skip over several of them. And then later on you go back and you're like, shoot, I probably shouldn't have taken that had I actually followed my pre-trade checklist. It happens. I mean, it happens to me occasionally as well. Obviously, eventually you'll get to a point where it will be unconscious competence, where the checklist is there, but it's really so ingrained in your head. But that takes a long time. It takes years, really, to get to that point. But it's something you really should. And I understand it, guys. I do. That, you might miss a trade here and there because you didn't get through the list. And then ultimately, because Murphy's a funny guy, that trade is the one that shoots the moon and goes crazy. And you're like, next time I'm just taking it. And even though it wasn't a perfect trade, you took it anyway, or you didn't take it because you didn't get through your checklist, and you get the point. So you don't want to do that. So we're going to talk a little bit about that today. But before we do, let us not forget about when will the insanity stop? When will it stop? Today's is another sad story. There's really nothing else to say about it. It's just a sad, sad story. So let's take a look at it. IRNT. I'm okay. Just need 300% to break even. The only hope is to get few contracts signed, and we'll beat the guidance. Really, beat the guidance? So beating the guidance is going to make IRNT pop. Apparently, that's what this person thinks. The problem is that we will continue to bleed on this never-ending downtrend. $3 is just around the corner. I feel like I want to die holding 16,000 shares of this effing POS. Well, you're $226,240 because you said you bought 16,000 shares. And if we go over to the right-hand side here, it says, don't really know what to do now. Got in at $14.14. I think that's what that comes out to, unless I did the math wrong. I may have done 1440, but let me do 1414 times 16,000. Yeah, that's the right math, Jared. Thank goodness they have calculators in Portland. So now, this particular stock, as of yesterday, was at $4.63. So $14 down to $4. I mean, first and foremost, let's be fair. This thing never looked good. It just never did. It didn't have a good pattern. I'm guessing this person got in over here, and you can see this wasn't that long ago, a week ago or so, that they posted this. IRNT, the call should be canceled. What they would say are, okay, we did. What a nice Christmas gift. You have to understand that and it's not being mean here, you're doing this to yourself. It has nothing to do with IRNT's guidance. It has nothing to do with what a nice Christmas gift. You did this to yourself. You. Okay, look in the mirror and stare at it. And stare at it till you recognize the person that's looking back at you. Okay, and when you finally recognize that person, that's the culprit. Okay, that's the person who put you in this position of losing $150,000. You had 226 grand in your account. You have 74 now. What are you doing? Like, what are you doing? I don't know this person. I don't know anything about them. But I'm going to guess it took them a little while to save that 226,000, and they're so cavalier about giving back 150 of it. This is why the trading industry gets such a bad rap, such a bad name, because of people that do this shit. Okay, and that's all it is. It's crap. It's garbage. Just don't do it. I'm hoping that these lessons will teach you guys what not to do. It's not here to hammer on people and to crap on people. It's here to show you that real people do these things and they lose real significant amounts of money. So don't put yourself in this position. Okay? Yeah, it is Davey Dave, but most people don't. They're like teenagers. They have to learn their own way. Well, okay, but just don't learn with so much money. Money management's your number one job. I tell you guys that all the time, but not everybody listens. All right, so let's move on. Perfect patterns rarely fail. PPRF. Perfect patterns rarely fail. All right. So when you look at this, we know that quality stuff has a higher likelihood of working, right? Everybody knows this. The question is, why don't we wait for it, right? So experienced traders, just to be clear here, they've earned the right to be a little bit more flexible, right? Experience isn't a measure of time, it's a measure of profitability, okay? And I don't like that when somebody tells me, yeah, but I've been trading 5 years, Jared, so I'm at $500 risk. And it's like, well, what's your profitability look like? Oh, I'm not very profitable. I'm just a little above break even. Why are you risking so much money? I had somebody the other day, a true story, come to me, send me a thank you email. And I hate this because they send me a thank you email and then I have to hammer them down. And I don't like doing that because they came in with a positive intent. Well, this person has a $25,000 account. They've been trading for 4 months, right around 4 months. And the last 2 months, they made 7 grand and 10 grand. And I said, I'm sorry, but you're risking way too much money. And most likely the 7 grand you made the month before, excuse me, and the other 10 grand is luck. It's just dumb, sheer luck. That didn't go over so well. They think that you're poo-pooing on their success. They think you're being negative towards their success. And I'm telling you, no, I am not. I'm telling you, you're trading above your pay grade. Okay? You're out there on the PGA Tour and you just happen to hit a couple nice drives by luck. All right? And you got a birdie a couple holes in a row by luck. And now you think you belong on the PGA Tour. You don't. You don't. And trust me, reversion to the mean is a very real thing and it will happen. Okay, so as I have said in the past, don't spend that money. The market wants it back. Okay, it does. So you made 17 grand you had no right to make because you risked too much with too little experience. And again, for those of you out there who think I'm kidding and you think it's a joke and you think, yeah, ha, 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 Jared, then you learned nothing from this. You learned nothing from this. There's no difference between this person and the person who made 17 grand in 2 months. You both gambled, one got lucky and one didn't. Flat simple. One got lucky and one didn't. Okay, and for every lucky person, there's probably 1,000 people that aren't. All right, so money management's your number one job. Take it seriously. All right, inexperienced traders do it by the book. You have to learn the basic foundation. You have to learn the basic techniques first, right? When you go to play any sport, the coach tries to teach you the basics first so you have a good foundation for later. If you learn poorly now, you will have bad habits you have to break later. And it's just much harder to overcome those things, okay? So learn the basics before you try to reinvent the wheel. And the reason I'm putting these in here is because, yes, there are some experienced traders out there that do some high level things and some things that maybe go a little against, the core values or fundamentals of trading. But they've earned the right to do it through years of experience and practice and use good money management. When you're new, you don't have that luxury. You learn proper or you just don't do it at all. So patience, discipline, and time. All right? So this is one of the things I want to talk about. Why do we take less than this? Right? This is old. I apologize. This is like very old. AMD is probably like $300 right now. I think this is like 2 years old. So I apologize. I just had to pull out a pre-market scan really early, late last night. And I was like, shoot, I don't have any like real recent ones. Anyway, so here is a dollar losers list, right? This is what I use to scan dollar losers. And you can see AMD down here, down 4.58% at $1.55. And what do you get here? You see the pink line. You're gapping under multiple 60-minute green bars, okay? And you can see that on the daily right here as well. So if you were to put a little dot down here, that dot would be basically right by this pink line, right by there, okay? Now, why am I showing you this? Because remember I said you need to start with a good foundation? You immediately thought, oh, we're going to go right to the 5-minute chart or the 2-minute chart on the pre-trade checklist. No, it starts long before that, okay? So, for example, I don't know if it's a good analogy or not for people that don't play. You don't just go out and hit the driver. You better make sure you're a good putter before you learn how to drive. Well, in this case, you better make sure you're good at picking daily charts and 60-minute charts. And they don't have to all be gaps. They don't have to all be gaps. You can pick just a good uptrending daily or downtrending daily, etc. But my point simply is, if you haven't sorted out the daily chart aspect, the rest of it doesn't matter. It's a very important point. Sounds so simple. If you haven't sorted out your daily and 60-minute charts, nothing else matters. Well, here's a nice gap under a green bar and under multiple pivots. There's a little micro pivot here and a more significant pivot here. So you've gapped under a green bar and 2 pivots. Well, that's pretty good. There looks like there's room down to about $30 to $31. So you have about $1 to $2 to play with here. That's a good foundation to start with. Start with that. Okay, and then we'll talk about the minutia, which we will get to. Okay, same. Here is a chart or a gap on ADP. Again, old. I apologize. All right, but it's good for learning here. What do we have the previous day? Big red bar. Day before that, mediocre size red bar. Pivot. Right, there's a little peekaboo tail there, but we're roughly at 170. Right, roughly. What's the stock gap into? It's gapping to $172. Okay, that's the 60-minute chart. That's the daily. This is the pre-market. If you mess up your pre-market scanning, you're going to have a hard time as a trader. Because again, it's not just about gaps. It's also about nice daily charts. But what are you going to be watching when the market opens if you started with junky 60 minutes and junky daily charts? You're going to likely be trading crap. And once in a while, you'll get away with it. We all get away with trading crap once in a while. Okay? But if you start with good patterns and good gaps, the higher odds are you'll be successful, right? So again, nice gap over multiple pivots, wide range red bar, 2 of them in this particular case, and gapping not just enough, but also not extended either. 4% gap, okay, on this. That's really nice. So now you know your foundation is set. And if you haven't taken professional trading strategies, you should. Why? Because there's a whole chapter on what a good gap looks like and how and where to find them, what you should be looking for. All right, so now that we have that, let's try to move the next step. Good foundation, start with a good gap, okay? Now, I'll throw you a little curveball, all right? What do you guys think here? So I gave you the daily, and I apologize. This should be marked daily, but this is the daily chart down here to the left, okay? This is the daily chart in pink. I apologize. So this particular stock is gapping into a red bar, okay? Wide bar, narrow bar, narrow bar. What do you guys think? Love it? Hate it? Maybe? Not sure? What do you guys think? I'll give you guys a second to look at. All right, 54 is the entry, 53.50 is the stop loss. It's a little 4-bar play, all right, and that's what the daily looks like. Too extended, it's going to topple over, no, and everyone else is like, I'm not so sure, and if I answer wrong, Jared might yell at me. Come on, grow a pair, all right? Too many bars up, daily 3-bar play. Really, a daily 3-bar play. That's an interesting one. Okay. All right. So you guys are kind of all like, it's tough, right? Well, this is what it did. Now, you're like, well, okay, what's your point? That is my point. Just because it worked, does that change our opinion now? It worked. It actually worked really well. It went like $3.50 on a 50-cent top. Does it change our opinion? And this is where traders really go wrong. And we see it all the time in the chat room. I saw it yesterday, right? On ACAD, or even today a little bit on Mo. They determine whether a stock was really good by what it did. Well, you can't do that because we're pattern traders. So you're going to have rules to follow. And those rules are very clear. You can do this, you can't do that. And there's going to be a checklist for it. So if the stock has some issues where you basically say, no, I can't take it because it doesn't meet my checklist criteria, you can't go back later and go, oh, I should have taken that. No. This is going to happen to you. You're going to, and the reason I chose this one is very specific. The reason I chose it is this is one that makes you go, right? It is. It's one you have to think about. See, there are some that are just garbage and you're like, no way. And then it runs and you don't even feel that bad that it ran. But then there's the tweeners, I like to call them, the ones that are really close. And you're like, well, it does check this and check that and check this, but it doesn't quite check enough boxes for me to take it. So say you needed 7 out of 10 boxes checked and this one checks 5. You're like, wow, it's close. And then it rips. And what happens? What happens? The next time this pattern happens, you take it, and that's the time it doesn't work. Because it didn't meet all your criteria. Because there are plenty of stocks that we talk about where we say, man, that thing really looks higher today. And then it goes higher. And then someone inevitably in the chat room will go, well, why didn't you take it? So, well, because it didn't meet my criteria. And they don't understand that concept. Like, but you said it looked higher and it went higher. So why didn't you take it? Because it didn't meet the criteria. And they're still not quite getting it. But it still went higher and you thought it was going to go higher. Yes, I know, but it still didn't meet my criteria. Round and round we go. And we do this to ourselves, right? It's easy calling someone else out publicly over it, but don't we do it to ourselves privately too? And the next time you bend the rules a little bit, and maybe once or twice it works for you, and you justify it. Now you're really going to do it again, and then it doesn't work, you know? So now, maybe a little better, right? I mean, we have the green line, which is support, 1, 2, 3, 4, like 5 pivots here. We finally gap just enough to get under that area. We're in a downtrend. That's good. It's consolidated for 1, 2, 3, 4, 5, 6, 7 days. Okay? Gaps down, and now we get this, right? Choppy little open on this thing, but consolidates right here at $17.60. Back towards the moving average, but it doesn't have to touch it. Okay, just has to get about 70% towards it. Professional trading strategies, very specific details on breakdowns, what you're looking for. Very detailed, like 10, 12 criteria detailed. Nice little topping tail shakeout right there. That was sweet. Put your stop loss above the topping tail. Put your entry at 1760. Goes lower, bounces up, goes lower, and then finally sells off here. Okay? So this is one that put you through a little bit, but it did ultimately go lower. And this is one that, well, maybe went 1R or more and then broke break even. And some people would have been tagged by that. Okay? So nonetheless, you start with a nice daily and then you break it down. In this case, no pun intended because it's a breakdown. But it's not just the nice daily. It's also the fact that you had a nice consolidation back to the moving average in a tight range. It's also the fact that you had a topping tail. What's the topping tail? It's a confirmation of weakness, right? It's the fact that buyers tried to step up and they couldn't do anything. They couldn't make an impression on the sellers, which by definition is weakness, right? They tried and they failed. And then it didn't just immediately go lower. It gave you 4 more resting bars. That's pretty nice, right? That's pretty nice. Okay, so those are things you want to think about, things you want to consider. Start with a nice daily, drill down, okay? But keep the patterns high quality, okay? Now, here's another one. And again, the reason I'm showing you some of these guys is I would love to tell you you should only ever trade level 1 gaps. I would love to tell you that. But you take about 5 trades a month, right? I mean, we get like 1 a week. Maybe 2, right? You take 5 to 8 trades a month, and you'd probably win 60 or 70% of them. Is that enough? So when I talk about frequency, there is a level of frequency that, you kind of want to have at least 20 to 50 trades a month on the low side, right? At least 2 a day, right? 3 would be nice. So you don't need to go crazy and take 20 trades a day, but you do need to take probably more than 0 to 1. My point I'm making is this isn't a level 1 gap, but it's a decent gap, right? You have this huge move up in a stock that was struggling, right? It was weak, and then you had this big move up, okay? Pulls back, tries to bounce, and then gaps under the bottoming tail and gaps under the pivot. And because of the smooth move up, it should have room back down, right? It should. So we're starting out with a decent quality daily chart. So I take a look at the 60. I always look at the daily and the 60. There's never a time when you're scanning pre-market, you shouldn't look at the daily and the 60, all right? So now we take a look at the 60. Now you can see this pivot on the daily becomes this triple bottom on the 60. Pivot, pivot, pivot. And you can see right here, you're just right at that point. But then, excuse me, you have another pivot over here. So this is what we would call your tradable void. Okay, so now the question is, how do we make money off of it, all right? Start with quality, daily, end with quality, 1 minute. This one's a little bit more aggressive, but again, it's a nice consolidation at that 62.50 area. And again, to be fair here, there's a chance I might put my stop loss above the high of the day, right? Even though it says 62.70 right here, which you could do, you're better off on a 1 minute chart, at 9:40 in the morning or 9:38 in the morning, okay? Putting your stop loss above the high of the day, and then possibly looking for an add area later. All right, so again, I know this is a little bit tighter, but I would give it more room, okay? I would give it more room, okay? So this ended up working out really well. I mean, it went $1.70 on a 20-cent stop. That's about 7 to 1 because you started with something that was really nice, and then you waited for a quality intraday pattern. You didn't rush into it. And guys, I want to be clear again. I've seen it already today. People are calling stocks opening range breakouts just because they broke a 5-minute high. Well, there's more to it than just breaking a 5-minute high, right? The gap has to be of a certain level quality. You can't just say, well, I kind of like the gap. I'm just going to take it on a 1-minute low. You can't do it. And the worst is when they work and you do it, okay? So you still need to have a pattern. We're pattern traders. Okay, so keep that in mind. I know the temptation, and this is what I'm trying to get at with this lecture. I know the temptation is huge. You look at a certain gap and you're like, I got to get it. And unless it's a certain level out of professional trading, you can't just jump in it. There are certain gaps you're allowed to, but most gaps that you see, you're not allowed to jump into that quickly. Okay, you guys have seen this chart like 500 times now. I use it quite frequently. Why? Because it's just so damn good. This is a gap over a double top, right? Quite nice. Why? Because it gapped just enough. But note, it is gapping from a couple green bars, not red bars, but it is taking out 1 pivot here, 2 pivots here, and 3 here. So this one gapped up, pulled back, engulfed, and left a little narrow range resting bar. You get a super 3-bar play. Okay? This is beautiful. And this is a type of gap you will see more frequently than a level 1 gap. But it's still a very good gap, okay? Perfect gap? No, but very, very, very good. So again, the reason I'm commenting on that is within your pre-trade checklist, I want it to be very cut and dry, but there should be slight flexibility. Right out of professional trading strategy, what do? We talk about must-haves and like-to-haves. And that's something I want you guys to get in the habit of doing. Must-haves, these are things you cannot deviate on. End of discussion. It's just cut and dry. Can't deviate. And then there's going to be other things that are a little more flexible, like when you're taking a buy setup. Well, does it have a bottoming tail? Well, no, but it's got a volume spike, it's at minor price support, it's at the rising moving average, it has market timing, and it has a narrow range doji bar. Okay, well, then I can overlook the bottoming tail, right? Because that would be a like to have, but not a must have. Do you see where I'm going with that? So you need to separate those, all right, between must haves and like to haves. Okay, and again, professional trading strategies does a very good job at differentiating the two. Same here. What do we have? I don't know why I didn't put the line there. But a gap, I wanted to put that there just to make it more pronounced. Give me one sec, guys. Apologize. There, okay? Give me 1 second. There, okay. Now we're good. All right, so this is the support area, 49 bucks. Big, huge green bar came in here. Big bottoming tail came in here. Pivot right here. Bottoming tail right here. What happens? You wake up, stock gaps just enough to get under 49 bucks. Nice. That's a very nice gap. And then some of you will go, what is gapping from a red bar? True. But it's gapping from a bottoming tail also, which means buyers definitely stepped up in here. And on top of that, you're gapping under 1, 2, 3 pivots. That's a pretty good shock value gap. And then you get a wide range bar, narrow range bar. And this is where, again, we're going to go back to must-haves, like-to-haves. Well, this is a pretty good 3-bar play initially. And then this little doji bar comes in, right? This little doji bar. And some people might go, well, that's not clean enough for me. And if you passed on it, that would be okay. But when I look at this and I think, wow, if I take this 3 to 4 bar play, and I understand bar 2 and 3 should have relatively equal lows, this is a bearish doji bar. So if it takes out the doji bar and comes all the way down to the low of the day, and it does it with this type of a gap, and if we threw in the market environment, it's hard not to take that, right? It's hard not to take that, okay? The goal, demand quality. Now, then there's nuance. So we start with the daily, gaps over a green or over a red bar, over a pivot, and another pivot. But the nuance here is twofold. One, there is a little topping tail to the left. And that topping tail is at, I don't know if this is 40 bucks, maybe it's 41, 40, 50, I don't know, somewhere around. It looks like 41-ish. So you have a little topping tail. Is that a deal breaker? This is the must-haves, like-to-haves. Is that a deal breaker? No, I don't think so because of the shock value of the gap. You're gapping over a red bar with a topping tail and a pivot and another big-ass red bar. A lot of shock value. High odds, this will break. Now let's move over to the 2-minute. And then you sit here again. A new trader might go, okay, great first bar, great second bar, but bar number 3 broke the low of bar number 2. I'm out. And that would be a lack of experience. Why? Because the bottoming tail here is actually a form of commitment, right? It's a form of confirmation. So bottoming tail means this bar was fully red at one point, and then it came back up and left a tiny little red doji bar. Battle tested, exactly. And then the green bar comes up and breaks the high. So to the new trader, they would go, oh, well, there's a lower low on that. But when you see the size of the bottoming tail, it made the trade even better. And that's something you'll learn as you gain more experience, okay? So this ended up being a really, really, really good trade, right? One I think we made 5,000 bucks on or something like that, okay? Nice daily, nice intraday. This is where fine-tuning your pre-trade checklist gets important, all right? So what about this one? We'll start on the left this time, which is the daily. So you have a wide range red bar, another red bar, and you're gapping over both of those red bars, second one with a topping tail, pivot, pivot, pivot. You're over pretty much everything. At first glance, damn, It's a nice gap. Right? It's your first glance. You're like, that's a pretty nice gap. I like it. But then you start looking up here. You're like, ooh, wait a second now. Now, granted, this 35% is when this stock's at $17. But when you gap from $12.50 to 15, it's $2.50, and that's about a 20% gap, right? On a $12.50 stop, $2.50 is 20%. Now you sit, you ask yourself, what does my pre-trade checklist say? Oh, it says if a gap is over 12 to 15%, I can't take it. But it also says, or should say, if it's a lower price stock, which needs to be defined, okay, then I'm okay to trade it. And this would fall into that category, that lower priced category. Okay, now, if this were a $150 stock, there is no way on God's green earth I would have traded this. I don't care how nice this gap is. If this was gapping up 20% and it was a $150 stock, that's not a biotech, okay? There's no way I would take it. No way. There's a 90% chance that stock goes dead sideways or pulls back. Right out of the textbook. So in this case, nope. It's a bigger gap than normal, but it's a lower price stock, okay? It's a lower price stock, okay? Why? Because they don't go higher. Because it's such a big stock, and the gap is so huge, it'd be a $30 gap. They just don't go higher. It's literally 90% chance they won't work. Anything over $75 to $100 for the most part, okay? When's the last time you saw Tesla or any stock gap up 20% and still go higher? No, people wake up and go, sweet, 20%, cha-ching, take my profits. That's what you would do. That's what I would do. If I owned a stock, okay, and it was like a swing trade, and it gapped up 20%. What would you do? Cha-ching! Cash register. Take my money. Take at least half my shares off, maybe all of it. Okay? And that's why it doesn't work. Lower price stocks are less susceptible to that. Okay? So anyway, we move to the right. We've kind of a little bit of a choppy pre-market here, and then the market opens right there. And note, this is 9:30, so the market's open. Chop, 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 bounces, gets a little bit smoother. So now you have a choice to make. You gotta ask yourself, okay, is the breakout at 1550 good enough? We know the gap's pretty good, okay? Over here, tight consolidation, bottoming tail, back towards the moving average, but it is a little bit sloppy. So do you nibble some at 1550? Does this meet your pre-trade checklist requirements? It might not. It very well might not. Okay? So this one I could see if you passed on it, all right, I would probably take it. But if you passed on it, I could see it. But I like both bottoming tails. I like that it's breaking above not only the high of the day, but the pre-market high as well in a stupendously nice gap, like the kind of gap that I would really be looking for an entry in, chilling my head sometimes sideways to look for an entry, which we don't normally do. Wide range green bar, narrow range red bar, narrow range green bar, rip. And that's about a 50% retracement. Okay? It depends if you want to use the low of the bar or the low of this. All right. So my point is this one does offer some question marks. And then that brings us full circle back to the daily chart. Does a high level gap like level 1 allow you to be more aggressive or a little less, let's say, specific with your entry? And that's the $64,000 question. That's the gray area. My answer generally is yes. Okay? So if you have a true level 1 gap, which this is pretty damn close to, okay? The percentage would throw you a little, okay? Can you be more aggressive? The answer is generally yes, but you still have to define aggressiveness. What does that mean to you to be more aggressive? Does that mean a 1-minute high? Does that mean a 5-minute high? If you say I'm allowed to be more aggressive with level 1 gaps, does that mean, okay, instead of needing 7 on my checklist, my pre-market checklist, maybe I only need 5? I'm okay with that as long as it's written down. But when you come in and there's a level 1 gap and you're like, all right, I'm just going to take it, that's a problem. It still needs to be written down. What's your modus operandi for each type of gap? Why? It just takes all the thinking out of it. It takes the whole thought process out of it. Right? Quality is not just for breakouts. It's not just for 3-bar plays. It's for all trades, right? Now, in this particular case, we don't have the daily, but when you see something pull back this far, I don't necessarily need the daily per se. Okay, it would be great if this daily chart was already down 4 days, but we have a stock here that goes from 74 to 60, and the beginning of it was just kind of like, no big deal, no big deal. Rock. Whoa, what happened? Okay? See, there's too many people out there that call something parabolic or climactic that's just not parabolic or climactic. So this is one, parabolics, in my opinion, one where you need to be very specific and very strict with your checklist. Because if they are not as extended as they need to be, you're going to get hosed down pretty good. They're going to have a very shallow bounce, and they're going to shake again. Okay, and even when you have a great parabolic, they still take a second entry sometimes. Okay, so just be mindful of that. Why do I say this? Because you're basically trying to catch a falling knife. That's what a parabolic really is. But we're basically saying the knife's about to hit the floor, so we should be okay. So you better make sure on a parabolic, a climactic, that your criteria is very detailed and you do not deviate from it. Okay, and as we know, some of those criteria are big bottoming tails, changing the color bars, super wide range bars, massive volume spikes, far from the moving average. Like, I'm going to give them all out, but you know what they are, right? You know what they are. Okay, in this particular case, this would have been the entry, 62.25 by 59.90. Wide stop, typical, because they're so volatile, right? You're looking at a $2.35 stop, but at the same time, it did go $5 or $6. You got 2 or 3 to 1 out of it. I'm going to repeat it one more time. I like beating dead horses. Specifically speaking for parabolics, you better make sure your criteria and checklist is met. Many of these will have a shallow bounce and just keep on going lower. You have to remember there's a lot of selling pressure here. A lot. We're trying to get in right at the bottom when all the selling pressure has been exhausted. Okay? This was a nasty pullback on this thing. Okay? Same with buy setups. Doesn't matter what the pattern is. All right? Doesn't matter what the pattern is. Make sure it's good. Really good. Okay? This one, some people could argue, is a retest. All right? But it is near support. Big bottoming nail, changing the color bar, rising moving average. It's pretty good. But you still have to look at the daily chart, right? You still have to look at the daily chart as well. Okay? So you just have to pick quality. I don't know why this is here. Let's just move that along. Again, this shouldn't be here. All right? You have to look at quality. Okay? You have to look at quality. All right? How did you get your stop loss there? What do you mean? It's right there. It should be low of the day or right under the bottoming tail. I'm not sure what you mean. How did you get your stop loss there? So anyway, right there, give them more room. Look for areas to add back. Give this the wide stop. Add back at 49.75, 49.80, whatever that area is. Then raise your stop up to 49.50. Buy here, wide stop here, add back here, raise stop here. Give the initial trade room. We've seen it in these volatile times, right? How whippy things can be. Today, as an example, I stopped out by a penny on Caterpillar. 1 penny to watch it go higher. We got back in fine. But the low of the day held, and we initially started with the low of the day. So you just have to give them a little more room. Look for areas to add back. Most of the time, they will give you an opportunity to add back. Okay? So just don't overcomplicate stuff, guys. Success looks pretty simple, right? I hate when it does this to me. 1 dot. There we go. Keep it simple. Follow the textbook rules. Money management, trade management patterns. Don't think you know better. You don't. You don't. Okay? Perfect patterns rarely fail. Demand quality. Be patient. What are the main points? Look for void. Look for relative strength and relative weakness, and make sure it is easily recognizable, a clean and clear pattern. The kind of pattern you should be able to show anybody that's a trader, and they go, yeah, I know what that is. I'm going to repeat myself, okay? Easily recognizable, clean and clear, okay? Clean and clear. I mean it. I'm not kidding. Clean and clear. And I'm keeping saying it like 14 times because most of the time you guys are bending your heads this way and then this way and you're going upside down on a headstand. And then you ask me about it later and I literally look at it and go, I don't know what you took there. I don't know what you took there. It obviously wasn't clean and clear, right? So you got to ask yourself why? FOMO? Or your checklist isn't that good, which is a possibility if you're new. Clean and clear patterns, all right? Clean and clear patterns. Perfect patterns rarely fail means likely fewer trades because there are fewer perfect patterns out there, right? Follow the rules, have a detailed pre-trade checklist. Higher quality usually means a higher win rate, higher accuracy, all right? So you have to go back to, wait for it, clean patterns demand the best setups. It's just so simple. But we get caught up in it. Well, Unmal called it. Well, Jared called it. Oh, my neighbor called it. Or so-and-so looks like they're killing it lately, on Tesla or whatever. I got to jump in some. Like you guys taking Caterpillar today at like 202.80 or something. I can't remember what it was. Why? Right? More money, fewer roller coaster rides, less stress. Higher consistency month to month, and you'll trade better when you're winning more often. You'll be in a better mood. You won't be pressing or pushing or stressing. I'm telling you, it makes a difference. It absolutely makes a difference. When you come in cool, calm, and collected because you've been doing well and you've been winning, all right, every once in a while we get ahead of ourselves. It happens. A little too arrogant, egotistic, it happens. But most of the time, when you're losing is when you press it more. When you do the wrong thing more often is when you're losing. I got to get my money back. Or I got to get out of this losing streak. So you take more trades. Admit it, right? You take more trades when you are on a losing streak than when you're on a winning streak. So like I said, think about it for a second. Don't just sit here and listen like a drone. Okay? Think about what I just said. Go back. Look at your trades. Look at the days that are red. Go back and look at those trades. Were they perfect patterns? Were they taken in a good or a bad environment? And did you take too many trades that day? Not just that day. Do it on the week, the month, whatever it is. Just go back and take a few months of trading and just kind of separate your winning and losing days and your winning and losing trades. Just do it. It's going to take you some time. It will, I promise. But you're going to learn and see some things that shock you, I think. Or maybe you know it, but it'll confirm what you already know. Okay? So peel the onion back and kind of find out to the core where you went wrong. Did you start by having a poor daily chart? Or did you have a nice daily, but the entry was too aggressive? Or did you have a losing streak on good trades, but because of the losing streak on good trades, you started lowering your quality because of FOMO, the need to be right, stress, duress, whatever you want to call it. Okay? Think of all that, because that's what happens. And what happens is the snowball grows and grows and grows and grows. That's a bad thing. We all go through it. You just want to do it as infrequently as possible. Okay? Jordan says, my best month of the year, I took 55 trades. My worst month, I took 80. That is pretty par for the course, Jordan, right? Pretty par for the course. All right? So I hope that you guys learned a little bit about how important it is to take high quality, clean, clear, concise patterns, perfect patterns, versus having FOMO, over trading, and doing all the things you know you shouldn't be doing. And the only way you're going to get around this is to have a pre-trade checklist, okay, that is specific and detailed. But that's only step one. If you don't follow it, it's not worth the paper it's printed on. So that comes full circle. Accountability partners, consequence systems, okay? Something to keep you on the straight and narrow. I know we like to think we're robots, but we are not. And sometimes we just do stupid stuff. And we need to remind ourselves how stupid it was through some form of consequence so we never do it ever again. All right? I'm Jared Wesley of Live Traders. We'll get back at it again next week.